Hello, my name is Martin Landry, the Director of the Portfolio Management Group of Avantax Wealth Management. Welcome, and thank you for tuning in to this December 2020 Market and Economic Update. Winter is officially upon us for the United States, and the dichotomy of events continue to frustrate and stump both financial and investment experts. Hospitalizations related to a burgeoning load of COVID-19 cases have been setting new record highs, but so has the market value of U.S. common equity. Forward-looking financial markets have discounted the unfolding near-term loss of business activity to rising COVID-19 infections and instead have focused on the faster normalization of economic activity that will occur after a vaccine has been sufficiently distributed. Not only do markets sense that the U.S. will better cope with the latest surge of COVID-19 cases compared to what happened during March and April of this year, they also believe that when push comes to shove, Congress will be quick to compensate those unduly suffering from the virus. The number of COVID-19 related hospitalizations last bottomed at a rate of 3.7 per 100,000 Americans on September the 19th and has since risen to a record high ratio of 15.2 on November the 21st. The prior record was 10 per 100,000 set back in April. Since COVID-19 related hospitalizations bottomed on September the 19th, the market value of U.S. common stock has managed to increase nearly 13% to a new record high. The equity market's increase since mid-September includes an astounding 25% advance by the Russell 2000 Small Cap Index of smaller companies. The faster climb by the Small Cap Russell 2000 reflects a healthy broadening of the current equity rally. As participation in an equity rally widens, the rally supplies more benefits to overall business activity. Of special importance is how the equity rally's improved breadth implies that smaller, highly leveraged companies may benefit from an increase of their market value and of their net worth. An increase in the market value and net worth ought to enhance the ability of high-yield companies to access financial capital. Leverage does not depend on debt alone. All else the same, an increase in the market value of businesses backed in corporate debt and or the growth of the business corporate earnings that service reduce leverage. Recent rallies in corporate debt and equities have largely stemmed from widespread expectations of a material expansion in corporate earnings in 2021 and 2022. Today's relatively thin credit spreads and richly valued equities warn of corrections if fears of a contraction of earnings take hold. Despite a sharp rise in virus infections, the credit rating revisions of U.S. high-yield issuers are showing fewer downgrades than upgrades thus far in 2020's final quarter. An improved outlook for operating profits, the lengthening of maturities, and reduction of interest expense brought on by debt refinancing, as well as credit quality enhancing mergers and acquisitions, help to explain the arrival of negative net high-yield downgrades. In addition, credit ratings have benefited from reductions in outstanding debt that have been funded by securing of cash via divestments or infusions of common equity capital. In response to the first wave of COVID-19, net U.S. high-yield downgrades soared from fourth quarter's 2019's 54 to 194 in the first quarter of this year, and in the second quarter, a high of 368. Subsequently, net U.S. downgrades in high yield sunk to only 29 in the third quarter, and most recently only 19 in the fourth quarter. Net downgrades equal the difference between the number of downgrades less the number of upgrades. The unprecedented adverse shock that accompanied COVID-19's first wave quickly ballooned the high-yield bond spread from mid-February's 344 basis points to the 1,013 basis points of March 20th of this year, or when COVID-19 related hospitalizations reached their first peak. The current upswing of hospitalizations to a new record high has instead been joined by a high-yield bond spread narrowing from 490 basis points in September to back to 377 basis points recently. It's interesting late this year to see that mortgage applications have yet to warn of a collapse in household spending. The nearly 89% yearly liftoff in the price of lumber futures favors a continuation of above-trend housing activity. Very lively readings on mortgage applications from potential home buyers suggest that the latest upswing in COVID-19 will subtract considerably less from business activity as compared with the first wave of the virus in March of April of this year. In stark contrast to homebuyer mortgage applications' 19.7% year-over-year increase of the 4 weeks ending December 4th, the moving 4-week average of homebuyer mortgage applications suffered a year-over-year plunge as deep as 31% in the span ending April 17th of this year. Burgeoning COVID-19 might be expected to prompt an easing of seasonally adjusted homebuyer mortgage applications in the first quarter of 2021, but the depth of the prospective decline may be considerably shallower than the plunge we had in April of 2020. Notwithstanding a sharp upswing in COVID-19 related hospitalizations, the home buyer mortgage applications of December's first week were 1.9% above September 2020's average. As inferred from recent consensus forecasts, core retail sales, which exclude gasoline station sales, are likely to fall by 0.3% over the month of November. This differs considerably from November's 2.7% monthly increase in November in mortgage applications. Resilient home buyer mortgage applications suggest that consumers possess the wherewithal to avoid a replay of the second quarter's calamitous plunge in household spending. And once COVID-19 risks have been sufficiently reduced, household spending may surprise on the upside. Since our last video, the United Kingdom, Canada, and the United States have approved the Pfizer-BioNTech vaccine. The signs of progress go well beyond this landmark step, with a start to mass vaccination in Russia, promising headline interim results for China's Sinopharm vaccine, and Brazil's announcements of new contracts worth 230 million doses and the production of roughly 300 million Sinovac doses. Global vaccine supply is likely to become plentiful as the year 2021 moves along. Achieving the top 10 developer production targets would deliver enough doses to vaccinate 85% of the world's population in 2021. Although developed market countries currently hold the largest supply contracts, vaccine demand is likely to be stronger in emerging market countries. A dose of caution for the United States. Vaccination is going to be limited by scarce supply in the U.S. until about April, at which point supply will then exceed demand and demand will limit the need for more vaccination. Analysts still expect large shares of developed market populations to be vaccinated by mid-year. The point at which 50% of the population is vaccinated looks realistic in April for the U.S. and the United Kingdom. It looks realistic for May for Canada, June for the European Union and Australia, and July for Japan. Most large emerging market countries should reach 50% vaccination in the second half of 2021. Russia is ahead of the pack and should get there by July, assuming priority access to their vaccine called Sputnik V. Considering new several contracts, Brazil should follow closely in August, China and Mexico should follow by October, with India bringing up the rear in December of 2021. This analysis reinforces the baseline forecast that widespread immunizations against COVID will drive a sharp pickup in economic growth for both developed and emerging market countries next year. Thank you for watching. Again, my name is Martin Landry. I'm the Director of the Portfolio Management Group at Avantax Wealth Management. Reach out to your trusted Avantax financial professional if you have any questions or concerns about how the current market and economic environment might affect your portfolio. Have a safe and blessed holiday season, and my personal wishes for a prosperous and bountiful 2021 for you. And as they say, we'll see you next year.